to do is touch on certain aspects in the presentation that I feel are important. Feel free to read through them. The rest of the presentation, if that's what you'd like to do. And I'll be here after the other presentations to answer any questions if you have any questions. Where I'd like to start is the economy and a bit of an overview on what's going on. And I think the one thing I can say is that nobody can predict what's going to happen. We've had invasion, the first invasion since World War II, the war in Europe. It's turned everything on its end, I would say. There are some things we can talk about that are definitely happening. As far as where the military initiative is going to go, we don't know. We don't know how the world economy is going to react exactly. One thing I would point out on the slide in the upper left-hand corner, inflation that central banks thought was a passing, transitory issue just 6 months ago are now convinced that inflation is a real problem. When I started this business in the early 80s, inflation was running 12 to 14%. I hope we don't get back up there again. Well, you see in the U.S. it's close to 10%, in Canada it's around 7, 8, somewhere in that range. The one thing I point out is the markets have not yet accepted that this is real. And we discussed this afternoon at our meeting. If it was accepted as real, you would have long bond yields somewhere in the range of 10 to 11%. We're currently looking at a long bond in Canada around 2.8 to 3%. So we're still in a situation where the central banks are being very aggressive. They do realize inflation is now a problem. Give you some indication of what the war has done. The war has really hammered the nail in the coffin of people that thought inflation was transitory. 25% of the world's grain and corn exports come from the Ukraine and Russia. Russia exports a significant amount of energy, oil and gas every year. And so this is going to cause real inflationary pressures. And the one thing I would watch out for if you're reading the news is once we start getting wage increases, reflecting inflationary pressures, we start seeing 4, 5, 6% wage increases. Now it's become institutionalized in the capital markets, in the labor markets, and more difficult to get rid of. So that's why you're seeing central banks being very aggressive. There's expectations of at least a 50 basis point increase next month for the Bank of Canada, the overnight rate, and we're going to talk about 75 basis points. 75 basis points would be the first increase of that size since the 1990s. That would send a definite signal to the market that the Fed is very concerned about inflation. Now, so for Canada, if you look at the Canadian economy, what are the negatives and what are the positives from what's happening? Well, the negative is inflation. Interest rates are going up. This could have an effect on our already overheated housing market. Generally, the central banks raise rates when they want to slow the economy. So that will, I just saw recently that the major economic think tank has had world expected growth for next year from around 6% to around 3%. So we're going to see a disruption there. What's the good news for Canada? The good news for Canada is we're a mini Russia. Everything that they export, we export. And I can tell you right now, a lot of people are lining up contracts with Canada, whether it's fertilizer, whether it's mining and minerals, materials, whether it's energy. We're going to see a lot of interest in what Canada has to offer. So I think we might get a little bit lucky this time. We might see that even though although inflation has gone up and interest rates have gone up, and that should be a drag on the economy, we may see that the fact that we are now exporting a lot more and at much higher prices than even I saw a recent report that if we didn't export any more of materials, just the fact that materials have jumped up in price would add 2% to our GDP. So that's very significant. I'm going to skip this slide. Actually, I'll point out one thing inside the upper left-hand side. The TSX is the only stock exchange globally in 2022, just looking back, to have a positive return. And that ties in exactly with what I was saying. Canada is a beneficiary of Russia and the Ukraine being taken out of the world economy. And I think that's what's going to happen. I think somehow we didn't catch on to Chechen or Syria or the Crimea in 2014. But everybody's watching now. And what we're seeing is pretty ugly. And I think what you're going to see is Russia being cut out of the world economy for decades to come. That's going to be a big benefit for Canada going forward. Giving you an idea of what's been happening with interest rates, you can see this chart. This is the 30-year long bond. You see that it peaked at around a little over 18% back in 1980. And you can see we reached a very low of around 1.5% recently. And you see this little line that's jumped up. That's the recent increase in the long bond rates. Like I said, it's a significant increase. We're up about 80 basis points, 0.8%. but the market still does not believe that inflation will not be brought under control. Give you a view of the yield curve, what the yield curve looks like. The yield curve in gold is what the yield curve looked like at the end of 2021, March 2021. And you can see we've had a sharp increase. The blue line is March 2022. So within 1 year, we've had a sharp increase in short-term rates. You might ask yourself, why have long-term rates gone up as much as we'd expect? Part of the reason is there's actually a lot of demand for long bonds from pension plans looking to offset their pension plan risk. And I won't go into detail on how that works, but there are buyers for long bonds in Canada. So as rates jump up, you're going to have a lot of pension plans looking to buy fixed income, which is a natural hedge for pension plan liabilities. I want to talk a little bit about the fund structure. A number of years ago, jointly we made the correct decision to introduce an equity component into the bond fund. This does happen. It happens regularly. There are other products that are very similar that have done the same thing. Every time that rates go down and stay low for a long period of time, investors start to look for alternatives, some way to add some extra return to fixed income. We did this a while ago, and it's proven to be successful. If you look at the index which we're measured against, the FTSE Canada Unit Bond Index, you'll see the allocation, 35% in government Canada's, provincial governments 36%, corporates 26.8%, and you'll see municipals at 2.2%. How is your fund structure compared to the benchmark? You can see that we have a significant amount in fixed income, it's around 70%. We also have the equity component, which is comprised of Canadian equity and Canadian preferred shares. You'll see that preferred shares at 15.5%, and you'll see the I don't see the equity on here. Okay, so I'll have to look for that one later. That one disappeared, but you have a similar amount invested in equity. Now you might ask yourself the question: how has all this worked out for the unit holders? And you'll see there's a lot of numbers on this page. What I'll draw your eye to is the top line. Since inception, this fund has returned 5.1%. See that the top on the right-hand side. What does that mean? It means that year in, year out, this fund has averaged 5.10% return, and the benchmark has averaged 3.18%. So the value added is very significant for this fund. It's around 1.92% since inception in 2011. If you look at more recent history, the total portfolio, look at the 1 year, 2 year, and 2 year numbers. Look at the 2 year annualized number, 9.48% annualized, with a value added of 10.98. We're now entering the territory of the bond market where bond market returns are negative. And you might scratch your head and go, how can you actually have a negative fixed income return? Well, it's pretty easy. Fixed income return comes from two sources. One is the coupon, and the second is if you have a capital gain or loss. And the bottom line is when rates rise, all bonds have a capital loss, and when rates fall, all bonds have capital gains. And to give you an idea how sensitive the market is to an increase in rates, all it takes is a 10 basis point change in a long bond. For example, going from 270 to 280, which is a very small move in yields, to wipe out the entire year's coupon income. So we're looking at the 1 year for the FTSE Canada Bond Index, negative 4.52%, the 2 year negative 1.5% over 2 years. To give you an idea, the long bond index, which has more duration, more market sensitivity than the Canada Unit Bond Index, is down around 10% this year. It doesn't take much of a change in yield to result in a positive and or negative return for bonds. If you look at the different categories, I'm going to skip the next page. I think this is really, I like this page. If you look on the left-hand side, you're going to see that I mentioned the fund returned 5.1% since inception versus 3.2% for the index. But what I find more reassuring is each of the components of the return, whether it's fixed income, bonds, whether it's preferred shares, or whether it's common equity, you'll see that the bonds outperform by 20 basis points, and that's what you'd probably expect for a bond portfolio. That's typical outperformance. 20, 30 basis points is a very good return, additional return over the market. Preferred shares, 6.2% versus 3% for the index, and the index here is the preferred share index, and common equity is 10% versus 7.2%. So everything has worked. We've done better than the index for the individual categories, and your portfolio as a whole has significantly outperformed the index since inception. So it's been a very positive move, and as I mentioned today at our board meeting, what you'll see, all things being equal, as rates increase over time and fixed income becomes more attractive, as the yield goes up, new money going into fixed income will actually receive that yield. You're more likely to see the fixed income component increase in the portfolio and the equity component decrease over time. I want to touch on something else that probably many of you have heard about, ESG. And ESG stands for Environmental, Social, and Governance. Probably where you've heard about the most is the environmental side. You're probably well aware that we have a carbon intensity issue in Canada. Canada is one of a number of countries representing 75% of the world's GDP that has signed on to have net zero carbon emissions by 2050. What does that mean? It means everybody in Canada has to reduce their carbon output. If you're the TD Bank or if you're Tradex, there's not much you have to do. Maybe you recycle your paper, maybe you have the temperature in your thermostat a degree lower. If you're Suncor or Imperial Oil, you have a lot of work to do. Their processes by definition are very capital intensive, require a lot of energy, produce a lot of carbon emissions, and they are working on doing that. That's the E part, the environmental part. What's the S? The S is social. And most people think that that's going to be a really big factor going forward this year as companies face the very difficult task in some cases of getting their employees to come back to work full-time. And how companies handle it will be an indication of how they're handling the S part. The G has been around for a long, long time, that's governance. How are companies being run? Do they have the right board structure? Do they have the right oversight in place? So that's the three things that make up ESG. We had our last score was an A across the board, which is better than our peers. It's a very good score. We have a three-core approach to ESG. We engage, monitor, and report. Engage with our companies, monitor what they do, report back. We're not an exclusionary investor. We don't believe if we sell our Suncor or Imperial Oil that all of a sudden those emissions go away. We invest in companies that are open to making changes, to making improvements in their environmental footprint, and that's what we look at. We look at direction, not where they are right now. So we also use ESG factors as to identify quality companies. Typically companies that are really good at ESG, having a really good score, they tend to be companies, that's an indication of a quality company. The third point is we believe in constructive engagement. Very, very important that we engage constructively with our investment portfolio companies to make change and encourage change. I'm going to move ahead. If there's any questions at all, please feel free to stop me. I'm going to zoom ahead to the next page. So there's the first hour or so here. Now, here's an example of our constructive engagement. I thought it was worthwhile mentioning. These are the 4 energy companies in our portfolio. And just to point out that energy transitions take a long, long time. We're still using wood and coal, which was around 300,000, 400,000, 500,000 years ago. It's still a source of energy around the world. Our estimate is it'll probably take another 30 to 40 years to have a major transition away from energy, away from fossil fuels and oil. To give you an idea, annual daily consumption of oil is around 100 million barrels a day. If you woke up tomorrow morning and every single car was electric, 90 million barrels a day. So we're not saving much. It takes a long time. Canada has a significant portion of the world's long-lived reserves. Our reserves are expected to run at about 20 years. Saudi Arabia, 50 years. The big U.S. oil drillers and European oil drillers, 7 to 12 years. So we're dealing with a very, Canada actually is the only, in my view, the only secure long-lived reserves in the world. So we need this oil. We're not going to be off oil anytime soon. We need to make the production of this oil more efficient and reduce the carbon intensity. And what you'll see here is the 4 companies we've had discussions with, and we feel we've had some impact in convincing them to set interim targets. Having a target of 28 years that you're going to be carbon neutral is not good enough. We need to measure these companies all the way through on an interim basis and see how they're doing, and that's what we did. So that's constructive engagement with our portfolio companies. I want to talk a little bit about our investment style. We're a value investor. What does that mean? And the same approach applies both to fixed income and to equities. So what we do, what a value investor does, the first thing we look for is a quality company. What's a quality company? You can see 2 boxes here, financial analysis and management strategy. Basically, a quality company is a company that has a long track record of being profitable, paying dividends, increasing their dividends, has very little debt, has a strong balance sheet, has predictable cash flows, and high quality earnings. Also, we're looking for good management. Management is really key. So once you've identified a quality company, an example of a quality company would be Manulife, Royal Bank of Canada. Giving you an idea, Manulife, when I started Manulife, they were just in the process of applying for a license to sell insurance in mainland China. I don't know if you noticed, but today, 70% of the revenue from Manulife comes from overseas. So we have a truly international company in Canada, or more of their revenues from outside Canada. They're on any measure you look at, they're a world leader. I don't know if you're into price earnings ratio. It's the valuation that we use here. You'll see the valuation methodologies here. Shopify, which is an Ottawa-based company you're all probably pretty familiar with, 6 months ago, had a price earnings ratio of 300 times, which meant that basically the price of the stock is 300 times what they expect the earnings to be in the future. Manulife, this international, high-quality company, 8 times. So give you an idea how we get really, so what value investors look for is a quality company first, then we look to buy it at attractive levels. You're never going to make any money buying things at very high valuations and selling them at low valuations. It doesn't work. And by the way, Shopify, since November, has come down about 7% in value. So they were 300 times, now about 175 times. Still in nosebleed territory and quite expensive. I'm going to skip ahead and talk a little bit about value versus growth, which I think is important. You probably heard this term value investing, growth investing. I'm going to move ahead. This is a chart looking at who has outperformed in the last 45 years. When value outperforms, that's the blue line on top. When growth outperforms, and what's a growth company? Shopify is a growth company. We're expecting significant growth in that company going forward. If anything goes wrong with the trajectory and they don't meet their targets, you're going to see a significant sell-off, and that's what we're starting to see now. The sell-off now is more tied towards rising interest rates, but also when you have a 300 times price earnings ratio, you have to have perfection. If anything goes wrong, that price earnings ratio is going to come down, and the price of stocks is going to come down. What this chart shows you here, that in Canada, over the last 45 years, value outperformed growth 68% of the time. Now, I think that's probably going to change going forward. We'll probably see value outperforming less, but we still feel this is a repeatable process in place. If you're looking for an example of a value investor, Warren Buffett is, you've all heard of him. Warren Buffett is a value investor. Probably worthwhile reading his biography. This guy mortgaged his house to start his funds way back when. I don't know if it's worth 150 billion today or 200 billion. I can't follow the numbers, but definitely it's done very, very well. And just to show you an example, a value company and a growth company. A value company example would be Royal Bank of Canada, and these are current market caps. So the value company usually trades at levels that are perceived below its fundamental value. It's actually trading cheap. They tend to have high dividend yields, low price to book, low price to earnings. Look at the market cap of Royal Bank, 159 billion. If you look at a growth stock, Shopify as an example, and I'm wishing all the best for Shopify. I hope they're a huge success. We need more of those types of companies in Canada. We definitely do. But look at the market cap, $67 billion for a company that's been around for about 5 to 6 years. Really it's a brand new company in a sense, a brand new niche market. Like I said, that $67 billion, if you roll back 6 months ago, Shopify had a bigger market cap than the Royal Bank. And we've seen it happen numerous times in Canada, whether it's Breex, whether it's Valiant, whether it's Northern Telecom. In Canada, we tend to have companies that come out of absolutely nowhere and become, at one point, Northern Telecom was 32% of the Toronto Stock Exchange. So Canada is that kind of a country where we do have these white elephants that show up every once in a while, and unfortunately the history has been that they haven't done all that well. We've got numerous cases. Whereas the Royal Bank keeps printing money day in, day out. Canadian banks are probably the best run, they are the best run companies in Canada, probably the best run companies in the world, amongst the best run companies in the world. And that's because we have an oligopoly where we only have 6 banks, and they have access to the whole market in a sense, and not a lot of competition. The last thing I'd like to show you before I open up the questions is how we look at the markets. If you're sitting in our driver's seat, and you're saying, okay, where should I invest today? And what we're looking at is forward price earnings ratios. This is by sector. So information technology, 37 times. That's been pumped up by Shopify, which is still trading at 175 times. As you look at downloads, that's very expensive. If you look at the market itself, it's 13.6 times price-earnings ratio. As you head down into the banks, energy, and life insurance, we're heading in the single digits. This is where we see the value. These companies are trading below their intrinsic value, and coincidentally, we do feel that energy and materials are going to do very, very well, given the global scenario I described for you earlier. The fact that we are now going to be increasing, not only in price, what we sell worldwide, but we're going to increase in volume, because Russia is not going to be there and basically cut out the supply chain. So what I try to do tonight is give you a bit of an idea, a bit of an overview of the drivers, how we look at fixed income, how we look at equities as well. At that point, how much time do I have left? An hour and a half. Three questions. Okay. So I'll open the floor to questions. If you have any questions about anything I brought up, I would welcome your questions.
No questions about 10 minutes, did you say?
You have a view how high long-term interest rates will go in Canada?
That's a good question. And I mentioned this in the meeting today. I would encourage everybody here who has trouble sleeping to buy the book. This time it's different. 800 Years of Financial Folly. It's a really good book written by academics. It goes through 800 years of booms and busts. And one of the lessons that you draw from that is that when levels that they drew from their analysis, is that when levels of interest rate, when levels of debt are very, very high, it tends to act as a brake on interest rates. So interest rates tend to be lower. They call it financial repression. When either corporate, individual, or government debt is very, very high, what tends to happen then is you tend to have interest rates that are lower than they should be. And that's the period we're in today. So the question is how much higher interest rates go? Personally, I don't think we can afford to have much more than probably a 2.5–3% increase in loan rates before it really starts to cut the economy. The Canadian government is well aware of this. And if you look at central banks and what they've been doing for the last 40 years, people are old enough to remember the Greenspan put, when Alan Greenspan was the chairman of the Fed, and every time the stock market went down, they lowered rates to pump up the economy again. Central banks don't like recessions, although that's not supposed to be their role. They tend to be pro-growth. Governments don't like to see things go wrong on their watch because it reduces the chance of being reelected. So I think you're going to see at most 2% increase in rates. We cannot go back. Imagine if you woke up tomorrow and the short rates were 21% and the long bond was yielding 16. We would have a major, major depression on our hands. So we're not in a situation where the economy can afford it. And that's why central banks have been more pro-growth. If we'd had a lot less debt, I think we would have seen rates go up a lot earlier. Central banks would have been much more aggressive. Any other questions? Great. Okay. At that, I'd like to thank everybody for listening. And like I said, I'll be around if there's anything comes up afterwards. I'm more than willing to fill in.